Welcome to the Cashflow Academy podcast. I'm your host, Andy Tanner. This is where we make investing simple. I'm joined today by my two favorite investing buddies. We have Noah Davidson in the house and also Corey Halliday, who's joining us. And we're going to speak today a little bit about the big market, broad market, big picture, talk a little bit about trends, talk a little bit about broad market index levels, the Fed, and where we think things may go. Drop by yourinvestingclass.com for free stuff, free goodies. And with that, like, subscribe. What's the other one? Notification. I'll get this thing down.
Yeah. Tell your friends.
We've only been doing the podcast how long? I'm still learning how to do it. But rather than just get to the topic at hand, let's do brief introductions for those that are new. Noah.
I like stocks a lot. Options are pretty cool too. I've been doing this for a long time now. I've been trading and investing for almost 25 years, and I've had the opportunity to teach tens of thousands of people. I don't even know how many people, quite frankly. It's a lot over the last 20 some odd years. So
it's funny with all the time, because the other day Corey said, yeah, it's sitting at this table, there's like 80 years of effort. Whatever.
Yeah.
It's pretty crazy. But
yeah, 80 years of experience between the three of us. Pretty cool.
Buffett and number we're closing on
have
200,
about
so
80 for Buffett by himself.
Per people,
yeah.
So, and we're certainly not in that league.
Something to work for.
Corey might be. But
Yeah.
Speaking of Corey.
Yeah, so I got my start around the same time as these guys and went the traditional route of getting licenses, worked my way up the ladder, became a Series 4 option principal, and like Noah, I like big stocks, and I cannot lie. So it's a fun business to be in. We like educating, and it's fun stuff.
I like big stocks, and I cannot lie. I like it, man. So we decided to talk and do a little commentary and kind of a state of the union on where the markets are. This has been I can't believe how wrong I am. And this is what happens. I'm always with my mouth bearish, and I'm always with my portfolio bullish.
Yeah.
And until the bearish comes, I'm like everybody else is. Everyone's bullish. Everyone's got a nice big delta, and we're riding this wave, and I'm continuing to ride this wave, and I see the account go up, but how
reluctantly
long?
bullish.
Yeah.
Yeah, I used to be cautiously bullish.
Cautiously bullish.
Now I'm like very afraid bullish.
Yeah, and it's more about, for us at least, it's more about new purchases than old stuff.
Mm-hmm.
Because, and we teach this, you want to maintain your portfolio. You don't want to constantly be selling your stocks and have to pay taxes on that. So what we do is we'll hedge, we'll protect as needed. And typically we wait until it's a downtrend, and it's not a downtrend. And so we're not doing a lot of hedging, but we're a little skeptical. I mean, really for me, it's been a 2024 story where, I mean, I'm a cheerleader for the markets. I've believed that the markets were going to go up and up and up. And in 2024, I just see way too many things that make me a little cautious. I think there's a pretty good sized downturn coming. But I also realize that the prediction of when is impossible to know. So it's more preparation. If and when it does start to turn down, I'll get hedged up. I'll trust that I'll know it when I see it. So
we spoke a lot about the lack of fear. VIX has been a little more elevated, don't you think? Even I tweeted a while back. I can't remember what day it was. I'm so bad with my tweeting. Do they call it Xing now? What do they call it?
I still call it Twitter and tweeting. Yeah.
You tweet on X?
Seems like a failed rebranding in general.
I think if I call it Twitter, everybody understands what I'm talking about.
Yeah.
But if I say X, I'm on X.
Like, that thing? Oh, yeah.
I hated Twitter because I just, Twitter, it just seemed like little birdie stuff to me. It just didn't seem like... I'm more of a guy that needs a sledgehammer and a shotgun in my life than a little bluebird.
With the size of those fingers, you're not sending little tweets.
Yeah, just tweet. I says I'm not doing that. I'm tweeting.
That's like
back then you had like 20 characters to say something.
Yeah.
And finally I broke down and I got on and started tweeting, and I'm inconsistent with it. I'm like, no one cares what I think.
Yeah. When there was a flash crash, I think it was 2011, 2012. and it was a fat finger mistake. Somebody had hit the wrong thing and
Andy's
sold.
typing.
And I was like, are we sure that wasn't Andy? Because
Andy ain't moving the market that big, I'll tell you that. But
he had accidentally sold a.
But anyway, I tweeted out the idea. I showed a chart of the S&P at a new high, but yet an elevated VIX.
Yeah,
a VIX that. In fact, I cashed in. We were talking a lot about the VIX trade recently, and the VIX trade is something Corey brought up. Noah and I were like, yeah, but man, it never stays there. But Corey's like, yeah, but if it goes there, remember that? What we were talking about?
Yeah.
It never stays. You're never going to get the full value of that thing, but on the spike, you can get some. So when it was down in the teens, I put on that spread on the VIX, and it was a nice trade.
Yeah.
And now I'm waiting for it to get back down.
And it's coming back down some.
A little bit. I mean, we're still. When do you like to put that on? What level?
Yeah, I mean, I don't really.
19 probably around today. Or
yeah,
like
but I don't really chart the VIX. I don't really feel like it's so much about charting it. It's more for me about sentiment of other things. So I'll be looking at like put to call ratios and some things like that, where it's like, okay, if people get too extreme on the bullish side and the greed is really hitting a high and market's up and it looks like it's just kind of top heavy and so on, I'll try to get out ahead of it, because I'll feel like, man, if the VIX is at 17 and I'm checking a lot of boxes of too much complacency and so forth, it's just a good opportunity to play it for that next spike up.
I don't really chart the VIX. I throw Bollinger Bands on it though.
Yeah.
2 sets, with one standard, one at the 2, and then one at the 3rd deviation.
Yeah.
And I just watch the range that it's in, and if it gets on the low end, and I think sentiment's probably a little overly bullish, and then I'll check like the put call ratio and things like that. And then on the high end, if it touches a 3rd deviation, that's usually, I see it hit that and then it retreats.
Which statistically, it's not supposed to hit 3 and 4, but the VIX will.
Right.
The VIX hits some extreme numbers that way. So it's a good way to kind of use that. I like that as a gauge for volatility, because I mean, if you're waiting for most stocks to hit their 3 and 4 standard deviations, you're going to be waiting a long time. With the VIX, man, it'll hit those numbers.
Well, and it's more of an indication to me as like when to close a trade, like the spread
exactly.
trade. So
yep.
I liked it. The reason I like that trade really a lot right now is because of how many people feel like I do. I think the market showed its hand with that big spike. People are so cautiously bullish that they're pouring money in, but boy, the first sign of trouble, they'll hedge big. So I think your potential for big VIX spikes are pretty high right now. And my spread was only, I think it was 21 or 20 and 21.
Yeah.
It was low enough in the teens that was within striking distance, and that's for the VIX to get to 20 is not hard to do. And I didn't take a big position. It was a doubling of the money, not the portfolio.
Yeah, but
because I wanted to practice the trade. It's not a trade I've done a lot, but to me it makes a lot of sense because it's so dang cheap.
Yeah, and you didn't even get one of those like massive spikes, and you still more than doubled your money. So you think about a greater than 100% return, and that's something that the VIX can offer, because I would assume, and I'm very confident in saying, if you had done a bearish spread on the S&P instead of that bullish VIX trade, it's bearish on the markets. Understand, VIX moves opposite to stock. For anyone listening, VIX goes up when the market goes down. So you either buy puts on the S&P or you buy calls on the VIX. But your trade in the VIX made money, whereas you more than doubled your money, but the S&P trade probably would have lost, and both would have been a hedge on a portfolio. So it just worked out really nicely for you to kind of play that spike and get an uptick in volatility. And even though the market wasn't going the direction you would typically need to be successful, it still worked out, because it's more a play on volatility, not quite as much on the direction of the market.
I like it right now. It's liquid. I don't remember how many contracts I did. It was a few. It was significant. It wasn't massive, but it's a trade I want to learn more about, and it's not one I've done a lot of. Have you messed with it?
I've had mixed success with my VIX trades. Like I've had, occasional timing issues on it. Where okay, I think I got it, and then it never really worked. I've done a handful of different strategies. My favorite and the one I've had the most consistency with is that debit spread.
Yeah,
because
it's just cheap.
Yeah, it's cheap, and you get a little offsetting on the time decay, and you don't have to have the perfect timing. It's one of those things, anticipation of volatility. And there's certain events or certain times of the year where I expect volatility. Typically see an uptick around earnings season, things of that nature.
So speaking of that, that's kind of where we're at. We've got some earnings to talk about. We've got some Fed to talk about. So, event driven, not necessarily related to the VIX, but let's talk a little about first the Fed. So you were looking up on, the watch?
Yeah, the CME
Fed,
market.
Yeah, Fed watch, whatever
Fed
it is.
Watch tool.
And they're what,
88.9% as of today. So they announced the policy statement's not until the 7th. So that's 2 weeks out
from this recording.
Yeah.
So it's at 88.9, call it 90, almost 89% probability of a quarter point rate cut. I can't remember which which his name escapes me at the moment, but he was talking this last week about a very steady, measured, if we're going to be cutting rates, we see it as a pretty slow and steady wins the race type process. You were talking about the idea that maybe they don't cut at all.
Yeah, it's really, there's been flip-flopping because we saw them cut by 50 basis points, and then the markets started to price in another 50 immediately. We got the jobs number, and that derailed that whole idea because jobs beat expectations, and so that dropped back down to 25. But the market's moving in a way that suggests the market, forget about people's opinions, the market doesn't think that there's a lot of rate cuts coming. So could they cut by 25? I still think that's the most likely. But if you think about since that 50 basis point cut at the last meeting, what has the market seen? They've seen rates go up, which would be counterintuitive to them cutting, right? That tells you the market doesn't think there's a lot of cuts. And also the U.S. dollar's been going sharply higher. Now, the U.S. dollar, when you look at it on a chart, it's versus other currencies.
Right.
So it's how is the U.S. dollar doing versus the euro and the yen. But currencies go up when rates are higher for that area of the market, right? If the U.S. dollar is climbing sharply, and it's as we record this, it's been going up for about almost 3 weeks straight in a
pretty good
straight line.
Yeah, and again, it's against it's 5 other major currencies.
Yeah.
So it's
going
good index.
Sharply higher. The Bank of Canada is cutting by 50 basis points. We just saw the ECB cut aggressively. So you're looking at it versus these others, and again, what the market is suggesting is that when people think that the Fed's going to start cutting rates aggressively and that rates are going to go massively lower, I think the market's poo-pooing that idea. Market's basically saying, no, we might cut a little bit more, but there's not massive cuts coming. And so that means, you can't extrapolate their current mode and think, well, mortgage rates are going to come down dramatically and all these things. I just don't. I think we're going to be at a higher rate environment for longer. So I think the Fed is, will it cut by 25 more? Well, according to the markets, there's an 89% chance. I kind of like the idea that maybe it's more like 60-40, 60 that they will cut, but I think there's more like a 40% chance they don't. I'm not expecting massive cuts from the Fed in coming months.
I don't think their problem has changed.
Yeah.
I mean, they made that cut. Some people say, well, that's a declaration of victory over inflation. Baloney. They haven't declared victory on inflation. That was a nervousness of the uptick in the jobs, in the unemployment. Since we didn't see that continue, they live to fight another day of inflation.
Yeah. Assuming they don't revise the numbers on the
the jobs. Yeah, maybe this huge jobs beat was actually a miss. We don't know.
We don't know. But the what's her name, SOM, the SOM rule we were talking about. It was triggered. And I just read an article this week that the creator of the SOM indicator, I can't remember her first name for the
Claudia
SOM.
Yeah,
or
what's she saying?
She's saying it may have misfired. She doesn't know yet.
Well,
she gave herself both sides to applaud.
So she's cautiously optimistic.
Yeah.
I like the Psalm rule, not so much historically for accuracy, but I love its philosophy.
Yeah.
I think philosophically it makes sense to have it's about 80% accurate from what I've read.
I mean, the philosophy of where jobs go, so goes the stock market.
Yeah.
I mean, that's a good rule of thumb and it's not so much what percentage you're at in terms of unemployment. It's the direction that it's going, meaning you could have unemployment at a high number. Let's say it's at 10%. But if it's on its way to 8 and 7 and 6, then the stock market's likely rising, even though it's currently at a high number. If you're at a really low number, if it's about to go up. And so the question people need to be thinking about is, well, in your opinion, where do you think jobs are going? Right now, the unemployment rate at 4 point whatever. Do you think it's going to get worse in the coming years and go to 5% unemployment and 6%? Because if you believe that, as jobs go, so goes the stock market. Well, if we're going to start losing jobs, we're probably going to see a stock market that's in a bearish trend. That's most of the time how it works.
A correction at a minimum, right?
Exactly.
I mean, you still look at like your Schiller PE, and it's still relatively high.
Oh yeah.
So we know that again, valuations are high. And so that the comment you made earlier about stuff you're holding versus new acquisitions. That's where I have a hard time is finding something of interest, because things are trading pretty much near all-time highs or at all-time highs.
Yeah. Let's talk about that, because you said events like Fed movements and also earnings. Let's talk about earnings when we come back a little bit.
Yeah.
In fact, that's exactly what we'll do. Is you're always very attuned to earnings and where things are, so we'll come back after a short break.
Really, I think anybody can follow Andy's steps to learn this. He made everything so easy. You can actually ask real-time questions with them and get real-time answers. There's so many different trading platforms. They will take the time and be able to show you how to use whichever platform you're on.
I've just really enjoyed how they have taken what could be complex material and really made it simple to understand. I learned how to take some of the complex trading strategies and produce cash flow. They really go beyond just trading stocks. They really make it about lifestyle to make yourself the best person you can be. Everybody that's an expert started out as a novice. You got to start somewhere.
Welcome back to the Cashflow Academy podcast. I'm your host, Andy Tanner. I'm here with Corey Halliday, Noah Davidson. We're talking a little bit about the broad market, the state of the union. We've been covered a little bit on rates. I agree with Corey. I think they're probably going to be stable. I don't think we're coming down. Why would they? Why would they? If they can kind of keep inflation where it is, I don't see any reason to cut it any further.
And having screwed up inflation so badly last time, I think they've got to play cautious. Yeah,
they got to keep it high. You mentioned earnings and you mentioned jobs. I don't know. Does AI? Let's talk about jobs and AI for a minute, because AI I think is a bullish thing. But I think there's always been the worry about losing your job to technology. For example, Henry Ford has labor on his assembly line, and then it's a robot. But those physical replacements, it seemed to, now you need someone to build the robots and maintain the robots. So it creates jobs. I think AI is a different story, because AI is not trying to create machines that do physical work.
Yeah.
AI is replacing the white collar job. And to me, that is a huge threat, much more than robotics. You pick a robot to go, pick a strawberry or something.
Yeah.
Great. You get an iPad to go replace a McDonald's, cashier. But I mean, lawyers, you don't need as big a team of lawyers when you have AI to do.
Yeah.
Accountants, attorneys, engineers, anyone that uses their brain.
Yeah.
So here's the thing. If white collar jobs shrink, that's profits, because you're not losing the jobs, you're replacing them. So when you say, the market goes up when, jobs are going up, jobs go down, that could actually mean more. sometimes when a company, look at it this way, okay, from a macro standpoint, if you saw jobs going down, you might be a little bearish. But from a micro standpoint, if I saw a company lay off a bunch of people, I'm like, that's going to help earnings.
Yeah.
Right? They're cutting the fat. They're getting lean. A layoff, a major layoff, for me means could be profitable. Even closing of stores. You look at Walgreens. They're going to close all these pharmacies, all these, maybe makes them more profitable.
Yeah. I think as a general rule, though, historically speaking, it's a bad sign when you have mass layoffs because something's gone wrong, right? Companies want to grow and they want to expand. So, I mean, if you look at the Apples of the world, they've been bringing on employees. If you look at the NVIDIAs of the world, they've been bringing on employees. These are some of the biggest, best run companies and so forth. And then if you look at where there's dwindling in a company's revenues and earnings, and they've had this, you know, it's like GameStop. They've had to shut down stores and restructure. Can it work? Yes. But as a general rule, it's kind of a bad sign for the job. You know, long term is like what went wrong.
It means they're not growing.
Right. It means they're, exactly. They're reducing work. I mean, but AI, I mean, that's where it gets tricky because, and you made an excellent point. Does it improve corporate profits, which would mean stocks are better?
Yes.
But reduce expenses? Because if you think about what's one of the major expenses that companies pay? Well, it's for your employees. Well, what if you could get rid of some of these lawyers and some of these accountants and some of this and some of that,
customer service,
and now all of a sudden,
all that stuff.
But I also think realistically, we've got to think about this in terms of how long is it going to take? Because take ChatGPT, which is maybe the most famous AI company right now. They just reported billions of dollars in losses.
Yeah.
Why? They have more people coming on and using their service than ever before. But that's how growth companies work. They always lose money because they're trying to grow, expand.
Yeah.
They're investing in the future. They're building out. They're bringing on more programmers and employees and trying to be the biggest and the best. So they're going to lose now to hopefully have a massive, massive audience and gain and all of that down the road, right? And I think every corporation that's big in the AI space is going to show billions of dollars of losses in their AI build out for the first few years. So if you're investing in Apple and Amazon and Google and some of these companies, you got to assume that, hey, it's going to hit us early on, but it might lead to much bigger profits down the road. I think that's the roadmap. And so when I look at the market and try to kind of forecast, I'm looking at corporate earnings taking a hit because of AI for the first few years and then maybe seeing the benefits massively down the road. Well, if I'm investing, if those corporate earnings and revenues and things are going to take a massive hit, you're probably going to get some discounted prices in stocks, and that's going to be the bargain and the opportunity.
Well, speaking of that,
I was going to say, this is why I like your nuclear play that we were talking about a week or so ago.
Nuclear.
Did I say nuclear?
You said nuclear.
Nuclear.
The nucleus.
Well, that's an example of investment dollars. So they, as a company, a big company transitions to more and more AI, the amount of computing power, the energy requirements for that. There's not a day that goes by that I don't see another article about that space, about the basic materials needed, the uranium, the relaunching, Amazon's doing it, IBM's doing it, Google's doing it. They're all investing in that space. And so, that's one of the things where you're kind of thinking about how the game is played, where the companies are going to be allocating resources. And again, it'll come off their top line, but it'll go into another sector.
So talk to me about earnings, because that's what we said we're going to talk about in the second half of the podcast. In fact, I think let's do a podcast on those trends of energy and computing. And
big trends coming up.
Big trends.
Yep.
But what are you seeing for earnings, Noah?
We're heading right into the heart of earnings season. Like the last week of the month, you've got all the big fish, not all of them, but a good percentage of the big fish reporting. Mm-hmm. I think that's really going to dictate which way we see the market moving. I mean, there's a lot of, I think, general hesitancy. We have an election coming up. There's a little bit of uncertainty there. The market, I don't really think, is an overly political machine. It cares a little bit about policy, but monetary policy and what the Fed's doing probably is going to affect the market more directly than.
And that policy's been the same for Democrats or Republicans. Borrow and print,
basically. Yeah. So it's kind of a constant.
There's no difference there anymore. It's just it's not about ways and means. It's appropriations that has the different. That's where you're gonna have the fighting is how in appropriations, but the Ways and Means Committee is borrow and print.
Yeah.
So the difference between Democrats and Republicans there historically over the past decade hasn't changed. It's not
the
going
spending's
to.
been on an uptrend.
Yeah.
And so exactly. You can count on spending, I think, is what you get.
They're going to fight over appropriations. They're not going to fight over ways and means.
Right. So as far as earnings are going, I've seen, optimistic forecasts, but it always comes down to it's twofold always. You get the number of what they've done, like this is what we've done, and then it's the forward-looking guidance. Yeah. Mm-hmm. And again, whatever cost-cutting measures or wherever they're going to be investing dollars or what they see forecasting in the market. Consumer confidence is kind of wavering. I mean, we're still in a high inflationary, like as far as prices go and cost of living goes. It's interesting to see what they're forecasting as far as sales and things go. But, I mean, that's the other constant is we're pretty good at consuming things. And it's going to be interesting to see how it plays out. So I don't really make predictions about earnings because I don't have any inside information ever. I just know that it's either it's based off of expectations and then what kind of numbers you get and then how that weighs against the expectations people had.
Yeah.
So, I could see like GE stock gap down pretty big on earnings recently. Netflix gapped, wasn't it?
Yeah, Netflix
gapped
went up.
Yeah. Yep. And, they had a huge customer acquisition, number that came out that was pretty good. So, I mean, it's always hit and miss. And, if it's a stock I own, I'll occasionally call her up before the earnings announcement so I can mitigate downside risk. So if you're in enough profit or you have to know a low enough cost base, I don't really care if it gaps down or up on earnings because over time it'll shake out.
To Corey's point, stuff I've had for ages. I mean, even a gap down is not going to get me close to where I bought it out, even close.
Right.
Some of the stocks you have just so much hair growing on them. They've been around for a long time.
But I think that's what the overall performance of the broad market is just going to be looking at these numbers coming out and the forward-looking guidance. And it could spur the market higher. There's some hesitancy out there right now because it's kind of like just flat. It's just kind of hanging out.
Yeah.
You mentioned the PE, Schiller.
Mm-hmm.
I mean, to me, historically, that's dumb money. Like money that's going in there now is kind of the dumb money, except for maybe AI
is the
maybe
wild
energy,
card. Yeah,
right.
I mean,
it's tough because you're at this precipice. God, I'm gonna have a peach in
I don't know how to spell that though.
Precipice.
If we're talking about something that could fall.
Yeah.
I don't know. Whatever it is.
Right before.
Yep.
Yeah.
Precipice.
Because we could go like precipitous.
Can you use that in a sentence?
That's kind of like the Steve Miller brand. Pompatus. I don't even know what that means. Precipice.
The pompatus of love.
Precipice. I don't know.
Precipice.
The edge of the top.
Yeah.
The ceiling. If you're spending, usually the dumb money spends a lot for little. And so it's very easy to look at the Schiller and just say, God, are these people out of their mind? Let's look at where we are. I'm putting a little bit of money into energy, into nuclear. Corey and I were talking, so I bought a little bit this morning. But into nuclear, but man, buying other stuff right now seems like dumb money. So it's kind of a tough call right now.
Yeah.
I mean,
we're
cautious. We're cautious, but someone's spending more money to drive this money market higher. And where does that money come from? Is it coming from bonds? Is it coming from gold? Is it coming from crypto? No. All this stuff seems to be going. Where's the money coming from still?
You got your constant 401k contributions going into price
isn't that just
averaging
nuts?
over time. Like there's a steady influx of new money every time.
Isn't that just a nutty idea with 401ks that you buy because you're on schedule rather than discriminatory buying? Like Buffett is very discriminant. He, no, nothing to buy right now. 401k people are buying all the time.
Yeah, I think there is.
That's going to create a bubble anyway. It's a good point.
Yeah,
Noah.
And I think there is a difference in terms of, like you guys were saying about forward looking. When you take earnings, for example, people are less concerned. We kind of know what today roughly is, but if you start looking out a year, 3 years, 5 years, it's much, much more difficult to figure out where earnings are going to be. I mean, the further you go out, the harder it is to kind of say, okay, well, what could happen in the next 5 years? All sorts of stuff, terrorist activity, wars, pandemics, whatever can happen during that time span. So as you look at forecasts, I always kind of think of this in terms of, it's kind of like we were talking about with AI, that from a logic standpoint, what tends to happen is that most people do most of their buying at the worst possible spots because that's when they have available capital. And they have available capital because the economy has been good.
They don't pack it.
Yeah, and it has been this and it has been that. But that doesn't mean that it's going to be for the next few years. It just means that that's when they and the market's been doing good. And so the temptation is, well, this is a good play. I have some extra and these people are making money. I don't want them to make money without me. People aren't, the greed doesn't kick in when markets have been down because everyone's in pain and whatnot. So people get nervous and they start hoarding their cash and they say, well, I don't want to put it at risk because this is a bad market. And it's counterintuitive because they should be doing the opposite, but they don't, right? And that's just the kind of the general public.
What I haven't followed this, Noah. You follow this stuff. What's consumer confidence looking like right now? Does anyone look at that?
It's pretty high. Yeah, I mean it's solid.
It seems to be on the ground, just observing it. I mean, people seem to be just the inflation has not curbed the spending. I think for a lot of people, and especially the middle class. I think the middle class is still spending.
Yeah, and it's because, again, if you generally consumer confidence follows asset prices in that most people feel good if, well, their house price is up and their, they have a job and so on. So it usually follows the economy. It's not a great leading indicator.
Yeah.
Once the economy rolls over and people are losing jobs and, well, then that consumer confidence looks terrible, but it didn't give you a great insight ahead of time. That's the problem. So.
Good point. It's an interesting time, especially the murkiness. It feels different. For a while, it felt a little bit like .com with all the NFT stuff and all the crypto stuff, and you heard a lot of people bragging about how much money they'd raised rather than what they've earned.
Yeah.
You heard people bragging about who they've recruited that did things at other companies that hadn't done anything at theirs yet. That crypto NFT hype seemed to be there. AI is different. Quantum computing is different. Energy is different. And so it's an interesting frontier to decide if this is dumb money or if we really are ready to hit a new level of, another rocket booster in there. I'm skeptical.
It might be a little bit of both.
Do you still feel, Corey, we talked about our armor levels, so we got to be careful because not everyone knows what armor level 1 is, but we talk about, armor is advanced risk management, opportunity readiness. And when you get an armor level 1, it means that people are just overconfident. Do you still feel that put to call ratio and the high Schiller and inverted yield curve and all these different things that suggest bubbliness?
Yeah, I mean, consumer confidence. And again, if you look at the trajectory of jobs, the unemployment rate down. And now it's, for the last while, it's been turning up. I mean, there's just, you check a lot of boxes that historically this is not a great place to buy from a longer term perspective. But man, I mean, having said that, Could it go up another year or something? Sure. That's the difficulty.
Well, the bear in me thinks, the bear in me, which is a constant little voice. It's like I got the angel on my shoulder, I got the devil on my shoulder, and they just have bull horns and whatnot. But the bear in me thinks this is very reminiscent of 2007. Asset prices were up.
Yeah,
they had just done a 0.5 point rate cut. The market managed to run up for like 3 more weeks, 6 more weeks. And then it kind of topped out, and it didn't turn down and crash overnight.
No, it took time.
But it took some time, and it did hit a top within a couple of weeks of that 50-point, 0.5 point rate cut. As asset prices were near these all-time highs, so they'd stayed paused a similar number of months, and it took them longer to raise rates up to that point back in 2007 and 8. This was a little bit more rapid onset, where they the fastest rate hikes back to back in history to kind of curb that inflation, and they pause, cut. And I think the cut, that in my opinion, just in my mind, it's hard for me to get over the idea that they're trying to stave off any signs of recession. They're trying to keep the ball rolling.
I agree. Not a declaration of victory on inflation, but more of a defensive move against.
We got to keep this party going. So it has that same feeling. But at the same point in time, portfolio's still bullish, and it's just me watching for any other signs that give me indications of how to react. I don't really think I can predict the markets. I've been wrong about my bearishness for far too long.
I've been wrong for a long time about my bearishness. A long time.
And that's just something I've come to accept. That the bear's constantly chirping in my ear, but it's otherwise.
Yeah, but look at behavior. But when I say my bearishness or your bearishness, what's your delta been on average over the past
super
20
bullish.
years?
I've owned more
super
stocks
bullish.
than ever before.
Exactly. In other words, we're bulls until we're not.
Right. Yeah.
So we're speaking bearish with our lips, like it's going to happen,
And I think that
but
comes
we're
from
riding the wave up.
Fear of loss is one of when we talk about like basic market psychology and behavioral economics.
Being old helps.
It does. It gives you some perspective. But having also lived through market volatility in the past, I'm like,
being old helps.
It comes, and you got that experience, and so it's not. Cautiously optimistic is probably the only way you state that.
And I would say it's certainly changed for us. Like we're always, hey, this is what's good about the economy. This is what's bad. You definitely want to own assets. That's your road to path to success. But it's changed for all of us in that this year, we didn't used to have the discussions we have in our text group like we've had the last few months. Something has dramatically changed in terms of, there's always, we're looking at what's out there and what could cause problems. But now we've struck a tone that's a little different than normal. And so I think it's important that we're not perma bears, and that I've believed in the markets and I believe there was value and so on. I have to say though, it's shifted. Shifted pretty.
And I think I still think there's value plays out there. Like I think over the next 5-10 years, the idea of the nuclear play is going to be you timing it perfectly. I don't think you have to do, because
even
I think
energy,
that
even the energy sector,
money's going to be there, right? I think again, you've got opportunities in the AI space where I think they're going to again keep producing chips. You're going to have a strong performance out of the chip makers like the Taiwan Semiconductors and the NVIDIAs of the world. Yeah, and you get.
Well, I even mentioned some of the old school, and I think IBM's been kicking NVIDIA's butt of late.
Oh, they've been doing awesome
in terms of charts and so forth. So, even within AI, there's some relative value plays because IBM trades at like 10 times earnings compared to NVIDIA that trades at 70 whatever time. So it's like there's some relative value plays even within the expensive sectors of the market too.
IBM's doing some interesting stuff with quantity. We ought to do a different podcast on this because they've been doing some.
Well, this will fit in our big trends idea.
We'll do that. As far as positioning goes, let's finish with this because it doesn't do any good to talk about a broad market if we don't come to a conclude on how we position. The first two pillars of fundamentals and technicals are simply informative, or should be informative, to how we're going to position ourselves. And then the risk management pillars, well, we were wrong. What are we going to do? So in this, you mentioned you hang on to your old stuff, cautious with new stuff. What's your positioning? Anything beyond that?
Yeah, I mean, big changes in my stuff in 2024 have been more entry into some of the nuclear stuff. I've gone pretty big in that, where, it was mainly Cameco. CCJ was a big part of my portfolio, interest and increase. But then even some offshoots, like I have owned some Constellation, just a small position in that. That's CEG, which is doing the power plant with Microsoft. I did end up buying a few shares of that, and then just some of the offshoot stuff, like in commodities, where I feel like there's two different value propositions in the market, where you're like, value stocks trade reasonably, but the growth sector and tech and some of those big names trade historically very high, and that's skewing the relative value of the market. And so I wonder if we might have a massive sector rotation where value kind of comes back from the dead, because it's been annihilated. I mean, the growth, if you break the market into two parts, growth sector versus old school value, growth has killed value, but value in 2024 has held its own. And so we're starting to see maybe this little shift. But you got to pick your spots in value, because I think there's a lot of zombie companies.
There's some zombies, but even you look at companies like AT&T, they're fine. They were just cheap forever, and they kept getting cheaper, and then they kept getting cheaper, and it's like, geez. And they finally started to turn the corner a little bit, like AT&T. Kraft Heinz is at 30 in the mid. Yeah. If you can get Kraft Heinz towards that 40 again, that shows kind of what you're talking about.
Yeah.
I don't think those are zombie companies.
No, they'll be around for decades to come.
Got moats.
Yeah.
Noah, how you position? I mean, I like to own stocks, and I trade a little options. You're more of you like to trade probably more than
I've got
hold.
like my cash flow stocks, the kind of boring stuff that you just write options on.
Yeah.
I've got my growth stuff. I've got, I'm probably heaviest in tech and AI.
Okay.
And the growth mode there. There are some values there, like one that I've got my eye on that I'm looking to acquire. I mean, never mind, I shouldn't actually say that, but Super Microcomputer Incorporated is one of the top on my list. I've got like my top 10 AI plays, and it's been on the list. And they had a stock split, 10 for 1 back on October 1st. And it's one of those stocks that actually has
big split,
a reasonably good PE ratio. Like it's 22 by comparison. So it was a big split, very expensive stock, as back in September. But in October, it becomes pretty affordable, something you can own, and again, get paid to buy it type of thing. It has lots of options on it. So that's what I really look for, stocks that I think can grow, but also that I can have options so that I can protect my asset, cash flow when I think it's overvalued, collar it if the market gets rocky. So it's pretty boring stuff that doesn't, and then I spend a lot of time speculating with options, like doing like debit spreads and butterflies and random stuff where I'm using a little bit of leverage, but it's a very small percentage of the portfolio.
I've done in the last couple of months, I've done more debit spread, and I even turned into an iron condor once, which I haven't done in a while, and they paid handsomely. An elevated VIX lures me into that stuff a little bit, because there's some high premiums there, and you can get pretty far out of the money and get some stuff. So I've traded a little bit more than I have. Maybe in the last 4 or 5 years, I've had more trades this year in position, just because an elevated, the VIX spike in the last couple of months, and when it's hanging out, when you get the VIX hanging out towards around 20.
Well, in the 20s when the market's at new all-time highs.
It's tough not to sell some premium.
Yeah, that's perfect.
Yeah, it's tough not to sell some premium. So I had that VIX trade that we talked about earlier. It was kind of interesting because I bought it. I mean, it's lucky.
Yeah.
You're in a debit when it's low, and then you're getting credit
when it's
higher.
Yeah. Buy low and sell high.
But it makes sense. I mean,
it's one of those things where why is the VIX elevated the way it is? Because if I was to say to you, the market's at new all-time highs and it's up here at
should have a 16.
What
VIX.
would the VIX be? And you'd probably
13,
say, 14, 15. Say, you wouldn't be saying 21, 19, 22 or whatever. And we were just at those numbers. So, does it make sense for the VIX to be elevated like that compared to where it historically would be? Well, I'll tell you, some of the occurrences where that's happened have been when bubbles kind of overflow, right?
Mm-hmm.
And so like if you go back to the late 90s in the tech bubble, the VIX exploded higher and the markets were exploding higher. So I'm not saying we're going to overheat.
Yeah, you are.
But I'm saying, I am saying that historically you've got to be aware that the potential for the stock market to actually boom higher and overheat on the upside is there much more than normal. Let me say that.
Like you say, it has changed. So that's a little bit on our positions. I think that's helpful because we can talk about Fed and talk about it all day long, but when, where's your money at?
Yeah.
Where's your money at? That really tells people, what we really think.
For sure.
Well, on offense, but ready to play defense is about how I think about the market all the time. So
there you go. You've been watching and listening to the Cashflow Academy podcast. I think my guests, Noah Davidson, Corey Halliday, for insight. I love talking shop with you guys. It helps me really get a better sense, I think, of where things are and where reality's at. So hope you enjoyed our conversation. Go to yourinvestingclass.com. Like, subscribe, notification bell, tell your friends, and we'll see you next time.